Hi everyone, my name is Liebenberg and today we're going to do a short overview of the Nedgroup Flexible Income Fund. As you can see there, the title of today's talk is Navigating Higher for Longer. And I guess as most of you know today, the narrative of rates and inflation being higher for longer has become more or less a consensus view, and we'll touch a bit on that during the presentation. Now on the first slide, we'll just go look at a short performance overview of the fund. And as you can see there, over 1 year, the fund's delivered just over 9% gross of fees. It's been a tough year for fixed income investment. So I think all in all, a fairly decent result. Over the quarter, like I said, it was actually a little bit more challenging. The fund delivered about a return of 1.5%. The biggest contributor from that was on the offshore side, 0.4%, and then local floating rate notes, 0.8%. You can see there the contribution from inflation-linked bonds and the nominal bonds, just about flat for the quarter. And that's due to, if you look at over the quarter, again, we got, high inflation numbers that proved to be quite sticky, and that scared fixed income markets. And as a result, if you look at US Treasuries, sold off by about 30 to 40 points over the quarter. And if you look at our local market, the All Bond Index delivered a return of minus 2.2. So quite a challenging environment for fixed income assets, but quite a decent return given the environment for the fund. So that's just a quick overview on the performance side. And I think although we had some challenging conditions, I do think it sets up the fund for quite a nice run into the rest of the year. If we then move on to, and today, what we thought we'll do is give you a bit of an overview of the characteristics of the fund and how we manage the fund. And this slide here just speaks to our philosophy and approach in managing the fixed income universe. We called it Diversified Alpha. And basically what it is, what you can see here is a wheel of all the fixed income universe that we look at. This will include money market instruments, bonds. We look at currencies, credit, structured notes, listed property, convertible bonds, prefs, and inflation-linked bonds. So as you can see here, quite a vast investment universe. This we look at in our local market, domestic market, but also offshore. So we look at the same set of income assets. This enables us to look at valuations and look at all these asset classes. We try and then figure out, given our philosophy, which of these asset classes are expensive and which asset classes are on the cheaper side where we should then allocate capital to. And having such a wide universe gives us quite a wide range of possible alpha sources. And part of our job is then to deploy capital to the cheaper asset classes, avoid the expensive ones. And hopefully we can then also, part of what we do is put together a well-diversified portfolio where we diversify the risk in the fund. So let's just give you a quick sense of, all the asset classes, income asset classes available to us. What's important here, I think, if you look at that in the inner circle, we can invest offshore. We can also take some of the offshore assets and hedge it back to rand. So you take out the currency volatility to some extent, or to a large extent if you reduce that currency component. But what it does leave you with is an offshore component, hedged back to rand, that's also a lot less volatile. And I think given what's happened over the past quarter, I think we thought it appropriate to share some other characteristics of the fund with you. In this case, liquidity, our liquidity profile and credit exposures. We had 1 or 2 credit events over the quarter, and I think these things have just come to the fore for investors. And as you can see there on the left-hand side, for liquidity, our flexible income fund, we can, on a same-day liquidity basis, liquidate about 30% of the portfolio. Over the next 3 days, about 24%, and then 3 to 5 days, another 27%. If you look at the cumulative percentages, that means we end up with about 80% of the fund which can be liquidated within a week or in a week's time, if that would be required. So given our vast or wide investment universe, we don't think we need to take all the liquidity and credit risk. We can actually take a little bit less of that. If you look at our credit exposures, if you look at on the right-hand side there, you can see there a big amount of government exposure and then our big banks. And if you look at some of the credit exposures, smaller exposures into well-known names that we think is fairly secure. So maybe as an example, if you look at subordinated debt, some of the banks, issue subordinated Tier 2 and Tier 1 debt. We don't believe, for instance, Tier 1 debt is appropriate for an income fund. And we believe Tier 1 debt should be viewed as equity. So that is excluded from our investment universe. And what you see here is ultimately, a result of our portfolio construction, and liquidity and credit does feature in it. So part of what we need to do is give clients the return they want, but make sure that we take not excessive amounts of risk. Now, all of this ultimately has led to some performance, and you can see there over 3, 5, 7 years how we've managed to outperform the benchmark of 110% of STEFI, while also outperforming the peer group. This is obviously the retail class, which is the most expensive fee class of the fund. If we focus there on 1 year, it's been a little bit more challenging environment for fixed income markets. We still managed to outperform the peer group, but lagging the benchmark slightly, given the little bit more challenging environment that we find ourselves in. So that is just the performance over the longer term. What's also quite pleasing, if you look at, over the long term, what has the fund delivered? It's delivered is beat cash, as you can see there, or just maybe I'll take a step back, and on the x-axis you've got volatility or risk, and the y-axis you've got return. You can see there how the fund has outperformed cash over the longer term and also the peer group. What is interesting and quite pleasing is if you compare to the all bond index, which has got a volatility at about 8, you can see there the fund's delivered returns fairly similar to the all bond index, actually slightly outperforming it over the long term. So it seems that over long term we've been managed to deliver what it says on the tin, but also do it at acceptable level of risk. And then maybe the last slide, what we've done here is just show our clients a couple of drawdowns over the last couple of years compared to some of our competitors. You can see their fund A to D. And what you can see there, typically, we've managed to achieve good relative returns, but at lower drawdowns. So for us, it's always coming back to, first is the return angle, and we want to obviously give clients what they want and maximize it, but it's also important how much risk you take. And for us, it's to maximize the return per unit of risk. That's important. And I do think also for an income fund, you don't need to invest in funds that take excessive risk. In income space, I think you want something that's a little bit more secure. If you want to take risk, go to equities where you can maximize your risk a lot more. I think income space is about quality of returns, making sure your client gets what they're aiming for, and that is stability of returns and high levels of income, but obviously with acceptable levels of risk. So that's just a quick overview of the fund. What we'll do now is move on to the market views, and I'll give you a quick overview of what we see in the markets. And I think the last quarter, again, you can see fixed income markets under a lot of strain. And this is just the US swap curve, how it's moved from end of December to March. So it's been fairly volatile. And if you rewind the end of December, the markets were seeing about 6 to 7 rate cuts in the US. We had this so-called pivot from the Fed and Jay Powell, and markets got quite optimistic. And you fast forward a couple of months where the US economy has been exceptionally strong. Inflation has been a lot stickier than the Fed and people hoped. And that meant that these 6 or 7 rate cuts is now back to 1 to 2 for the rest of 2024. So there's been a big cutting back of easing, monetary easing in markets. And that's obviously also affected our local market. And that's had a big knock-on effect across the board. And like I said, this by and large was due to quite a strong US economy, strong labor market, sticky inflation. Now, if you look at the inflation, and let's rewind a couple of years ago, we would all remember we had this inflation shock, which was driven by COVID and these supply chain bottlenecks. Now, you can see there on the top, or if you look at goods inflation was a big issue around supply chains, and you can see how this disinflation has actually got inflation a bit lower in the US. But What we haven't seen moderating would be services inflation. You can see there the bottom bit there where services inflation has been quite sticky. Typically, services inflation is more a function of wages and the labor market. You can see there on the right-hand side where non-farm payrolls, which gives you an indication of the labor market, has been quite resilient and actually exceptionally strong given what we've seen, how quickly rates have gone up. So long story short, we are concerned that rates, even though it's become market consensus, rates and inflation will be higher for longer. I think the Fed has got quite a difficult job in getting inflation back to 2 or even 2.5% given the strong market that we've seen. So I think that is going to be a challenge for the Fed, and obviously that's got a knock-on effect globally. Now, if we come back to SA and a little bit more inward looking, we had the budget in Feb, and the budget was, if you look by and large, I think quite reasonable, more or less what the market was hoping for. Deficits were largely in line with the medium-term budgetary policy statement. I think the one thing which was not a surprise, but the markets wanted to see, was JAFECA, which is the Gold and Foreign Exchange Contingency Reserve accounts, where we tapped into those unrealized profits. And that enabled us to lower our debt to GDP profile by a couple of percentage. So our debt to GDP seems like that's going to peak now, if you can see there on the graph, at about 75%. We've managed to marginally reduce bond issuance, and typically the mix of issuance from government has improved slightly. On the negatives, I think if you look at revenue assumptions was, I think, a little bit more positive than we thought. And then on the spending side, things are looking, is not as prudent as we would like. Although the recent numbers have shown that actually on the revenue side is looking a little bit better than we saw in the budget, and also on the expenditure side, that's coming a little bit. And I think the third point there, I think SOE spending and the issues around Eskom and Transnet is still unresolved, and that will obviously put further pressure on the fiscus going forward. So by and large, I think it was a decent budget, but I think longer term or even medium term fiscal consolidation is crucial for the market. On the local rate side, like I said, we had the same issues. I mean, we're a small open economy. So, I think what we saw in the US had a spillover here. And our cutting cycle is now also being pushed out further. And also we believe our cutting cycle is going to be shallower. So maybe we get 1 or 2 cuts during the year. We see the full cutting cycle as maybe between 1 and 1.25%. So hopefully we can get a repo rate from 8.25%, maybe closer to 7%, but it will take time. At this point in time, when this recording was made, we actually the market is not even seeing a cut this year, post the higher than expected inflation out of the US, and that was the March number. On the inflation side, we've always said we don't have a demand side inflation issue, but our inflation is stickier than we would have hoped for, and then obviously there's administrative components, etc., which is keeping our inflation in check. So we don't see inflation going well below, any time below 5% in this coming year. On the bond side, we do believe our bonds are on the cheaper side. You can see how we look at our bonds. You can see the US real of 2%. We have an inflation assumption, and then we can back calculate a country risk premium, and that's 4 to 4.5%. Our fair value assumption is 4, given our SA long-term yield of 11.8%. So we do believe our bonds are on the cheaper side. If you look at break-even inflation, where's our positioning? On the shorter end of the yield curve, break-evens are about 5.5. So you should be indifferent between nominal bonds and inflation-linked bonds. So our inflation-linked bond component is positioned on the front end of the yield curve, and we do have some nominal bond exposure at the belly of the curve. And both of these asset classes look quite attractive at this point in time. A 10-year yield of closer to 12%. If you make an inflation assumption of 6, you're getting a real of 6 over the term, and that is quite attractive. You could argue that you could buy some nominal bonds in lieu of equities. That's 6% approaching long-term equity risk premiums. So I think bonds locally and offshore is looking quite attractive at this point in time. And then what have we done with the portfolio? Like I've said initially, we touched on that diversified alpha approach, looking at a vast array universe of fixed income assets. We try and obviously avoid expensive asset classes, invest in the cheaper asset classes. Diversification is important. I think it's a fantastic time to be a fixed income investor. If you look at the real yields available to income investors, it's the best it's been in years. The 12-month forward yield of the fund is 9.9. Our total duration is about 1.4, of which 0.8 would be local nominal bonds, 0.3 inflation-linked bonds, and 0.3 offshore bonds. So we don't have excessive duration risk, but we do think it's, you do need to extend your duration slightly given where we are in the cycle. Our total currency exposure is only about 4% at this point in time. If you look at the makeup of the fund, we've got a big floating rate component giving you money market plus about 1.5%. As mentioned, we've got a nominal bond exposure, inflation-linked bonds, which is a fantastic hedge against the weaker rand, but also unexpected inflation. And then you can see our offshore assets of about 18%, which is a fantastic diversifier. So all in all, I think a nicely diversified portfolio. And I repeat what I said earlier, I think it's a fantastic time to be an income investor if you look at the real income yields available to investors at this point in time. And given markets have, re-rated slightly, higher yields are there at the end of first quarter of 2024. And that should bode well for income investors over the medium term. Thank you.